Good afternoon or good morning, depending on the time zone that you might be tuning in from today. Welcome back to another session at FinTech Nexus, how alternative data is transforming the small business lending market. Before we go ahead and have our panelists introduce themselves, just a couple of quick announcements. First, special thanks to Isham and the team at Enigma for their support. Enigma has been supported for a while now, so we greatly appreciate the partnership. Also, thank you to our esteemed panel of guests, for your time and energy for participating today. Obviously, without great speakers, we can't have these sessions. And to our audience, without an audience to do these things for, it doesn't make for an interesting session either. So thank you to the audience, as always, for coming back to another session, and we look forward to hosting more in the future. As well as, speaking of the future, coming up in May is our annual FinTech Nexus USA event. 4,000 plus of your closest FinTech friends, May 10th and 11th. There's still plenty of time for tickets, sponsorship, and speaking. So go to fintechnexus.com and check out all the details for our event. And now, without further ado, I'm going to let my panelists introduce themselves, and we'll get on with our show. So first up, Isham, I'm going to start with you. If you could tell the audience a little bit about you and a little bit about Enigma.
Absolutely. My name is Isham Udgiri. I'm the CEO and co-founder of Enigma. I am a reformed data scientist who's been kicked off of my own technical team and lucky enough to be running this merry band of folks trying to bring actionable intelligence on the identity and health of every U.S. small business.
All right. Thank you, Isham. Jim.
Hey, my name is Jim Cummings. I'm the co-founder and COO of Ampla. We are a financial technology platform for consumer brands. We offer capital, banking, bill pay, cards, and a host of other financial solutions geared directly for the growing consumer brand.
All right. Thanks, Jim. Lindsay.
Lindsay Cooper, partner at Deloitte. I lead our audit and assurance fintech practice in the Bay Area.
All right, and Yakov.
Hi, good afternoon, everyone. My name is Yakov Ehrlichman. I'm the head of small business credit risk at Stripe. I've been here for about 3.5 years. I oversee the capital business, which is Stripe's lending product, helping to originate billions of dollars to small businesses across the country.
All right, thank you for those intros. And to the audience, as we go throughout here, we do encourage your participation. So if at any point you have a question, please use the Q&A box in your Zoom window and just go ahead and input those questions, whether it be in 5 minutes, 10 minutes, 20 minutes, but please use the Q&A function. The chat, please use that for general questions. Will there be a recording? Yes, there will be. If you need a phone number to dial into, we can provide that for you, but use your questions for the panel in our Q&A window. And on to our discussion. And Yakov, I'll start with you, and Jim, I'd love for you to chime in here as well. Our session title is Alternative Data and Transforming Small Business Financing. I think a lot of people are pretty used to hearing what alternative data sources might be on the consumer side. But is there a common definition of alternative data for small business lenders? And when answering those questions, give us a sense of kind of where the target is that you focus on in terms of who you lend to.
Yeah, so it's a great question, Todd. And so unfortunately, there's not a common definition of what alternative data means. It can mean a number of things to a number of different companies. Coming from the perspective of Stripe, we probably consider alternative data something that is very mainstream for a lot of other lenders. We have the luxury of being in the payments flow and having access to users' payments transactions. And for us, that is our core data. What we consider alternative data is more of the bank data, financial data, commercial bureau data that a lot of lenders view as integral to their business, but we actually view that as supplemental to our core decisioning logic. And so, we're always looking for ways that we can increase any of the alternative data sources that we use in our underwriting decisioning.
Yeah, I would agree with most of what Jakob said there. There's really no definition for what alternative data is. It's really what can you get your hands on, and what can you reliably use to underwrite for your target customer base. And I think that's kind of where the opportunity lies for fintechs like Ampla or Stripe as they're growing their lending business. The way that I think about alternative data, and Jakob kind of touched on this with the first party data that Stripe is generating on their platform. There's really like 4 different types of alternative data, the way that I think about it. There's zero party data, which is data that the customer is intentionally, and proactively providing to you. So that could be, linking their bank account, linking their accounting system, things like that, where they're providing that data to you. Then there's the first party data, which is what Jakob was talking about, and being within like the payments flow and having that data that, Stripe themselves are generating, or Ampla themselves are generating within their platform. The third one is second party data. So that's, first party data that you could go out and buy from, a provider. They'll package it up. And then there's the third party data, which is, scraping the web, looking at LinkedIn followers, looking at their website to really understand, what's out there publicly on that business. And then for each of those different types of data, there's different use cases for each of those, within, any up and coming fintech business.
Isham and Lindsay, you both come from a different perspective than where Jakob and Jim sit on the lending side. And you have many different clients and of different shapes and sizes. How is there some common areas or data that you typically see them using when they're looking to put into their lending models, and kind of how vast can it get? I mean, we've heard some examples from Jim and Jakob, but through the clients that you have, what do you see when it comes to the types of data that they're using?
We see things that run the spectrum on our side, but if I can quickly touch back on the first point, I think one super fascinating fact about small business lending compared to consumer lending is that even the data that's not considered alternative, i.e. bureau data, is very different than bureau data on the consumer side, which has standardized around FICO and all of these things. Whereas on the small business side, the bureaus each have their own point of view as to small businesses. There isn't quite industry scale and adoption and standardization of scores. And you see this in places like the secondary markets, right? So small business debt, almost no one trades it on the secondary markets, whereas consumer debt, about 40% of it gets securitized because the data is there for people to rely on a standard, kind of beyond the lender's door. So we see all things in terms of what people are consuming, but I'll let Lindsay chime in. I couldn't help myself on that one.
Yeah, so we're seeing more and more institutions move to adopting a strategy that includes bank account and transaction data. And that's because, bank accounts exist widely, whereas credit scores, as was mentioned, may not. And so the use of that bank account and transaction data can give really a more, detailed and timely view of the business. And, you can sort of use that cash flow data as a proxy for revenue, apply some assumptions around, costs, and sort of that can help you determine really, the predictive factors around, probability of default, ability to pay, and can also then, building that out to even include, early warning indicators around your customer base.
We've heard a lot the last couple of years, with the impact of COVID and kind of the shift towards, a more digital first approach in all phases of lending, whether it be consumer, small business, or even real estate. But, Isham, I'll point to you on this one first again, which is, how many banks and fintechs today are using some of this data? I mean, is it widely adopted that it's kind of par for the course, or is it still very much depending on who the organization is, depending on the risk that they might take on? Kind of what does the broader view of what we're talking about look like, and has that shifted the last couple of years with the onset of COVID and the digital first now being kind of more to the top?
That's a fantastic question. Listen, I think we're in the early innings of alternative data being used in the SMB landscape. Of the things mentioned, open banking, for instance, like not widely adopted even by the banks themselves, who have such a strong relationship with the client. Transaction data, something that Enigma is very familiar with. We're out in market, providing intelligence that's coming from transactions. And we view adoption as really kind of opportunistic by folks. Like, it's the first time that they're adopting it. There's an education cycle, has huge impact, but we're not there on it being, as kind of widely adopted as it was in consumer space, or as it is, let's say, in the investment management space. So I think that we're still early, but a lot of that has to do, not just with the data not being there. A lot of the underwriting in small business, hasn't been innovated upon in a long time. PPP was certainly an exercise, and COVID was certainly an exercise, and everyone understanding who's who, and folks like Ampla and Stripe, innovating not just on, the data that bring, but the actual financial products that they bring to the table. That's what's going to push more and more adoption to the data, I think, is this rethinking of what does the small business need, on what terms, and what kind of data can we get to support that need. And it's coming really from the product side, which I think is fascinating.
We had a question come in from the audience related to, the adoption of different types of scores. And the question is there a reason why credit scores for businesses from vendors such as D&B, which is Dun & Bradstreet, have not been adopted in the same way, and therefore not considered as traditional as consumer credit scores from the bureaus?
Yeah, I'm happy to address that one, because we spent a
Sure.
lot of time looking at D&B early on. When we were starting our business, talking to advisors that have previously built out, fintech businesses and underwriting models for SMBs, and spoke to a bunch of supply chain partners that really understood like what's reliable. And what we found is that there's just not enough data within D&B to make underwriting decisions for SMBs. As you move up market and you're working with bigger and bigger customers, they have a lot more trade credit history that gets reported on to providers like D&B. But for SMBs, it's generally, there's just not enough data coverage there for that to be a primary source of underwriting.
Lindsay, I'd be curious to hear your thoughts on if there is, like, what could potentially change adoption of some of this data. I mean, you mentioned the bringing more lenders are bringing in bank account data, but is there particular barriers to potentially bring on more of this data, or is it, depending on who the lender might be and kind of where they sit? Because ultimately businesses are not as easy to address overall as a consumer might be. And the difference between a business with 1 million in revenue and 100 million in revenue is pretty vast.
Yeah, we're definitely seeing it gaining momentum, but I would agree it's still very early on. And it's doing that analysis. We're starting to talk to organizations around doing the analysis of, what does a traditional underwriting look like? What is that costing the business? And the benefit of adopting a more tailored approach. And it's hard to predict and put the numbers there as to what that's going to look like, forecasting and the benefits. I think we all acknowledge, right, there are benefits to that approach, but I think getting the support around, it takes a lot to implement and develop and get the support for investing in those costs. And that can be harder for smaller organizations to do, and really quantifying what the benefit's going to be to the business, financially, and doing that down the road.
As a reminder to the audience, if you have questions, we've gotten a couple come in so far, so please keep inputting those questions, and we'll continue to pose them to our panelists as we go throughout. And remember, please use Q&A, not the chat function. Yakov, I'd like to get you back into the conversation in terms of, data can say a lot of different things. When you do incorporate some of this alternative data, or incorporate all different sorts of data, especially these days, does it allow for a better view into the risk of a potential borrower, and how the company is actually doing, maybe versus historical data, especially given the current environment that we're in, where risk is so much higher than, say, a growth period when you can lend, and today you have to be a lot more careful.
Yeah, no, it's a great question. I think, yeah, in a bull market, I think we're definitely using alternative data more on the prospecting side, looking for ways to just grow originations, because generally the tides carry all ships, and so you can ride that wave. But I think in the current climate where things are a little bit more precarious and things are a little bit more uncertain, leveraging any source of data, alternative or traditional data, is going to be very much focused on the underwriting piece, on the risk assessment. And I think we're also much more cautious about using that data to really understand a borrower, more so than thinking about ways that we can unlock opportunities for that borrower. So we're very much focused on getting the best risk assessment that we can possibly get, bringing in all sorts of data to truly understand that user, so we can provide the right lending option for that borrower at the right time.
Jim, I'd love to get your thoughts on kind of the different stories that data can potentially tell. I think it was you in our prep call mentioned, data from the Fed, and it could give the impression that the small business market looks good right now, but then you dig deeper and it can show different type of problems.
Yeah, I think this comes back to my initial point around like the type of data and where you're getting it from. So zero-party data and first-party data that you're getting directly from the brand or from your own data that you're generating internally, I think is the most valuable in terms of how you update your models and how you underwrite companies, because you're getting daily updates on what's going on within your portfolio and also within the market. So that's definitely something that we focus more on, especially over the last call it 6 to 12 months with some of the changes in the macro environment. I think a good example of this, on our end, was really the onset of COVID, where the consumer brand space really took off on the e-commerce channels, and we saw a lot of our customers growing quite profitably on the e-commerce channels because everybody was shopping from home and ordering online. Where towards the end of 2021, where you saw kind of the iOS updates, e-commerce became less of a profitable channel for brands. So they had to tightly manage that. So those are the types of adjustments that we're able to see on really a daily basis through zero and first party data.
We had a question come in here from our audience, and feel free for anyone to jump on this one, which is any perspective on value added services like cash flow analysis, accounting / advisory services. Are lenders open to using fintech providers using APIs?
So I can take this one. I think there is a lot of value in using, the financial data, cash flow data, balance sheet, income statements when you're underwriting borrowers. The challenge is for SMB borrowers that data quality is quite low. And so we see that there's a lot of, if you're doing bookkeeping out of your basement for your eBay business, like how good are you about updating QuickBooks, right, with all of those transactions, right? So there is value, definitely, if you can get good data, but the challenge is just getting good data.
Yeah, I would echo that point. Making sure that you understand the quality of the accounting is very important if you're going to use accounting data, where if you're using bank transactions data, it's immutable. So it's pretty clear on what the data is and where it's coming from.
And I think what we're seeing is that typically the institutions are looking for the bank data first, and then as they're building out, looking to add and incorporate those other sources of data like the accounting data down the road, but are looking more first to the bank transaction data, sort of a first step, and looking to alternative data.
And when we talk bank transaction data, we're also talking PDF statements. In our little corner of the lending world, people are still very excited about digitizing bank statements in PDF with high fidelity. the actual conversion rates to open banking, when you ask most folks, look like 20, 30, 35%, unless the product is way more tightly integrated. But for your average lender who does want to get these things into play, very often they don't have a fixed set of requirements when it comes to data. They have multiple workflows, multiple paths for people that come into the door. So there's a lot of mixing and matching, getting comfortable with the risk, and kind of playing with the cards that are dealt from a data perspective that still plagues SMBs.
Another question here from the audience, I think this is an interesting one, is where do you see the investable opportunities around SMB lending? The options Claire in our audience gave is underwriting, data aggregation, loan disbursement, lending in a box.
I think everyone's very excited about SMB, especially post-COVID. I think the kind of market realization and wake up is that this is almost half of the economy. It's actually quite resilient, and we really don't know how to service it. We could barely give them free money. It was a very hard thing for the government to do. We couldn't even track them down. We still don't know what was fraudulent, what wasn't. But I think everyone kind of, saw gold in them hills, so to speak. And a lot of people are waking up to what's investable, what's exciting from a lending perspective. Many of the fintechs, kind of the latest wave, like Stripe with its capital program, folks like Ampla, Shopify, Square, have innovated on the actual product side, offering different kinds like MCAs. And I think this is another question in the chat. MCAs used to be really frowned upon, were mostly used by payday loan type shops, but have now been turned into a product that is actually really exciting to the business owner, kind of more closely mirrors their journey. To answer the question exactly, I think folks are, for the first time, realizing that the juice is worth the squeeze, that it's quite hard to get everything you need to do right to invest in SMB. But I think they're not discerning in terms of what opportunities exist. I think people are looking around the table and hitting them up, all around, and successes, especially in places like card, new entrants in card has been very surprising to a lot of folks.
Yeah, on the question that Claire asked around opportunities to invest in SMB lending, I think there's opportunities in all of them. I think it's just how do you actually execute on them? If you were to invest in like an underwriting or lending in a box, you'd want that business to own the risk first, because you want them to kind of have that skin in the game and really understand what they're underwriting. And I think that's something that I think Ampla's, to toot our own horn a little bit here, has done really well, because we've been very focused on a specific customer base, the growing consumer brand, and we've been able to really build our underwriting engine and the rest of our platform around the consumer brand, which I think is really important. I think what you're going to see is a bit of a disintermediation of SMB lenders focus on different verticals, because there's a lot of different SMBs that are up and coming. You have YouTube creators that have millions of followers that there's value in lending to those businesses also. That's not something that Ampla is going to touch, because it's a very different customer base. So I think there's opportunities in different verticals to really double down and understand how to lend to different types of SMBs.
And is in some ways, the term SMB starting to change, because YouTube creator, I don't know if I would think of that personally as a small business, but I guess you're right. I mean, they are. But does that potentially change some of the way in which these companies are looked at, and how is the evolution in trying to keep up with change in the broader life? How complicated can it get?
Well, I would say that this doesn't even apply to SMBs. Like, I think from our perspective, I think we service companies much bigger than SMBs. We're servicing enterprise, level brands at this point. We have multiple brands on our platform doing hundreds of millions of dollars a year in revenue. So this problem isn't just companies doing, $1 million to $10 million a year. Like this problem and opportunity is much bigger than just the SMB space. And I'm solely just talking about consumer brands. There's a variety of different, solopreneurs and small businesses popping up in various industries where there's a ton of opportunity for, alternative data and SMB lending to continue to grow from here.
Lindsay, I'd be curious your thoughts on the investable opportunities question, and the firms that you guys work with and talk to. Any one of those that are kind of jumping out in terms of areas in SMB lending that could be improved, or something that you hear from clients that would be a big help?
I think we're seeing a lot on the underwriting side as we're having a lot of those discussions on how to improve that underwriting. What does that model look like? Is it build versus buy, and working through that decisioning and helping our clients work through that.
So we've gotten a number of questions. So audience, keep them coming. So thank you. We have one from an old friend, Matt, in our audience, Matt Gamzer. To what extent are you offering beyond credit services, such as taking the transactional information and offering ERP or other financial management services for the SME borrower?
That's exactly what we're doing at Ampla. So we've launched other services around our, we call it our flagship growth line of credit. So like I mentioned at the beginning of the call, we're offering banking, bill pay, analytics, cards, and we have a few other products coming out also over the next few months. So from Ampla's perspective, that's exactly what we're doing.
Question from anonymous. Unless the underwriter has already got scale, it seems like access to first-party data in terms of payment experience or cash flow history would be fairly limited for new players. So unless there is industry-wide sharing of trade flows, it seems like newer underwriters would have to use two different models, one for existing borrowers and one for new borrowers. Any thoughts on this?
I can take this. I'm not sure I fully understand the question, but I do think that there is something to keep in mind, that performance data is important as well, right? It's not an alternative data. That's a core input to your underwriting models. So when you have a new borrower, you have no historical relationship with that business. And so you kind of take a leap of faith using the best data you can to make an assessment of whether they're going to pay you back. But once you start to get repayment data, then that is important information to use in your decision. If that user is paying you, they're overpaying you, they're ahead of their payments, that's great. They'll probably be a good prospect for an additional loan. But if that user is delinquent, that you're having issues collecting, then you probably are not going to extend another credit offering to that user.
So we had a question.
Yeah, I would just add a little bit more to that point. And I think the question really touches on a really interesting point around, growing a fintech business. The credit really is like a flywheel, where it's difficult to get that flywheel started, where, the better your data, the better your underwriting, the lower your loss rate, the more extensive and, better capital solutions you can provide. And to the point of the question, like it does take a little bit of time to get that flywheel up and running, but once you have it, and you have access to that data and you have that performance history, then you have a bit more insight into what data is actually providing signal and what data can you rely on to underwrite.
Another question from Timmy in our audience. Unfortunately, many SMB, and he defines them as sole proprietors and gig workers, were completely excluded in COVID relief, yet represent a massive labor market, similar to the thread we were talking about a few minutes ago. How far behind, they say bank underwriting, but maybe underwriting overall, from lending to this sizable portion of the SMB economy? So how far behind are underwriters on lending to sole proprietors and gig workers?
So I think I could take this one. I think it's a hard question to answer because although these individuals consider themselves as SMBs, they still resemble consumers, right? So they
Yeah.
don't tend to separate their bank accounts, right? They don't have separate bank accounts. Their their mortgage payment, their car payments, their childcare is all being paid from that same bank account. So you can't treat them as a pure SMB prospect and underwrite them as you would maybe a business that's incorporated, has separate financials. But at the same time, this is their business. And so I think that there is an opportunity for lenders in this space to get more granular on those types of users. And I think some of them have, some of them have, but it is a very nuanced type of lending.
And to kind of tack on a point that may not seem obvious to folks who are not in this space, like the biggest difference between consumer and SMB lending is that the use of funds are completely different, right? In consumer space, people borrow money to have fun and consume, go out shopping, go out to dinner. In SMB world, they're paying for equipment. They're making payroll in between a bad month or two, right? And so the use of funds, and to Jakob's point, like having more specialty lenders, like say someone who's here to specifically finance, someone's like vehicle for gig work. That distinction is very important in SMB and kind of how all SMB models are built. They're not built on, probability of defaulting because you're going to lose your job. They're really trying to look at the business. And, there's this open question in SMB lending as to how much is personally guaranteed versus not personally guaranteed. Are you really underwriting the business? Are you underwriting the person? These are still open questions, really, because every institution has a different point of view. And I think I agree with Jakob. The more you specialize in who you're lending to and what you're lending for, the easier it is to kind of include everyone in that category.
I mean, is there a common definition of small in small business?
I mean, we've seen a bank client define it as anything below 10, and then another define it as anything below 100 million in revenue. And I can guarantee you those two businesses look very different.
Yeah.
These are two top 10 banks, but it has to do with their strategy, right?
Yeah.
Some had like a bank branch presence that was very wide and could hit up the smallest of the small, and others didn't. And so, it's still lumped together. I think everyone gets the okay user experience of not being a Fortune 500 company when going to the bank, but
I mean, we've focused a lot of our time on the benefits of this data in lending. I mean, are there negatives to using some of this data? And what are those, and how big can some of those negatives be? Maybe Lindsay and Isham, love to get your thoughts as to that work with various clients in this space.
Well, I think the point was already mentioned, right? If you're using the bank account data, you've got to make sure that you've categorized it appropriately. I think that point was already made, right? If it's mixed between the consumer and the business, so you've got to know what data it is that you're using. And so that's where I think it's helpful that, in addition to that, maybe that transaction data, you're also using credit data to the extent it exists, right? So you're not looking at, multiple factors that are available. And then, it's really, I'd already mentioned it, but I think really the cost and the investment in getting it up and running, right? And then, once that's up and going, you've got the ability to do the back testing and do the data and refine the modeling and continue to do that, and it gets better. But at the initial investment, I mean, it's a lot depending on the size of the organization and the ability to do that.
We've had sure, go ahead.
no, sorry.
I was going to say, we've had a couple of questions come in from the audience asking about, kind of what the industry outlook is in 2023. Anyone want to tackle that question? And kind of, obviously, we're entering into a more challenging environment. We're in a more challenging environment. Do you, since we've gotten it a couple of times in the Q&A, I figured I'd pose it to the panel.
It's definitely going to be a challenging time for businesses in 2023. I think no one is would be surprised to hear that, but I would posit that the conditions during COVID were like fundamentally much harder for any small business trying to operate in the real world, and to take that as a sign of relief. I think the macro trend of people not wanting to deal with megacorp anymore when it comes to getting their food, their consumer products, just the ability for an SMB to scale the way it hasn't before, without much resources, go direct to clients, talk to the largest beverages companies in the world. They're not scared of their biggest competitors, scared of 1,000 microbreweries coming for their business. I think it's an exciting time, and you have some big macro tailwinds for SMB. So 2023, who knows? Like, we're all in that boat together, but beyond, I think folks should find a lot of respite and just consumer preferences. We're going to make it easier for folks out there.
Yeah, I would agree with Isham there. I think it really depends on what SMBs you're specifically talking about, and kind of what is their angle and what is their competitive advantage. Kind of like what I mentioned earlier, like during COVID, we saw tremendous growth within the e-commerce space, for consumer brands. Similar to what Isham was saying, like there's a huge movement, within the consumer to focus more on health and wellness. And there's a general distrust of these larger corporations that have potentially had not as healthy for you or better for you products. And there's a massive wave of these consumer brands that are capitalizing on that opportunity and communicating directly with their consumers, whether it be through Instagram or through LinkedIn. And there's just it really depends on which SMBs you're talking about. So in terms of Ampla and how we think about things, we're excited. Like, we still think the tailwinds are there for consumer brands to continue to grow. And if there are struggles within other lenders, that we just view that as like an opportunity for ourselves to continue to remain disciplined, focus on the data that works, and the data that we know provides signal for underwriting.
I wanted to pick up on the point we've mentioned it a few times during the call, which is about open banking. I think we're all, at least most of us, are probably in the boat that eventually will get here and be more widely adopted. But I mean, is that the case? And would the onset of open banking in a bigger way here in the US, as it might be, say, in the UK or Europe, would that dramatically shift where the market is today? Would it kind of give a supercharge into some of the things that we've been talking about? What could be the impact of open banking on the this market that we've been focused on?
I'll jump in here. Listen, I think at the end of the day, the data that's coming from open banking is data that most lenders require anyways for a loan, right? People want to see bank statements. I think the cost to originate and service loans with open banking and that kind of access is going to go down dramatically. But that's the interesting thing about open banking. It's the automation. And we're still not seeing it there from a business owner comfort sense. And I think the right to privacy is an important thing, which is why you see in places like Europe mandating that open banking connections only stay live a certain period of time. So we're already starting to see some pushback in Europe against open banking from consumers, owners. But I think from a cost perspective, it's going to do wonders for the industry, and that's really the hardest part, right? At the end of the day, how much risk you can take is really a function of how expensive it is to originate, and you can take some more losses if it's easier and cheaper to initiate on the onset. And I think that's really where it's going to come in and help.
think to add to that is really going to be a benefit for businesses as well, right? It's going to democratize data in a more accelerated way, and it's also going to force lenders, not that they're not already doing this, but to differentiate on the product side, on the underwriting side, right? If everyone has access to the same data, right? So you just need to have better products or better underwriting or better models to be able to ingest that data and output a more ideal offer for a business. So it's definitely a positive for the SMB, I would say.
We had another question come in from Matt in our audience. I'm going to rephrase it a little bit and ask, currently the SME market is underserved. Would the onset of open banking help shift that and continue to get more SMEs to be served, or will it not impact it that much? And what are some other ways that the SME market can go from underserved to being better served by different types of lenders?
Yeah, I'm not sure the best way to answer that. I think it's a tough one to answer. I would just say that similar to the points we were just making on the last topic, the easier it is to get data, the cheaper it's going to be to build an underwriting system, and the more fragmentation and disintermediation you're going to get that are going to be focused on specific segments of the SME market. And therefore you'll get better access or democratization of access to capital over time as these products become cheaper and cheaper to build. So that's kind of like my broader way of answering that. I don't have like specifics on that, but that's how I think about that problem.
Yeah, I'll add something to this. I think that there's the data piece, but there's also a lot of other considerations that go into lending in a market, which are like the compliance, the regulatory space. There's a lot that's needed for that infrastructure to be well developed for lenders to feel confident about going into this space in an aggressive way. And so I think there has to be the data. Yes, the data is important, but it's all of those other factors that need to be considered as well when thinking about emerging markets.
He followed that up with, is there any interest in serving some of the SMEs in emerging markets where they're even more woefully underserved than the US market?
Well, I may just want to, challenge that point for a second.
Okay.
I think some of the things that we learned in the United States around small ticket MCAs, we definitely learned from the emerging markets. Kind of financing, cash flow, factoring, buy now, pay later essentially came from Brazil, right? That's like the main mechanism of purchasing most goods. Or no kind of credit cards in places like Brazil, widely used, but you do buy now, pay later for a TV when you go into a store very commonly. I think that emerging markets, given the constraint of capital, you see a lot of innovation come from them. So I do want to make a point that there's a lot of innovation from a financial perspective. Now, of course, there's not much capital to begin with to serve SMEs at the scale that we do in the United States. But I do think you see innovation, and I do think that innovation actually has leapfrogged back to our markets in a super positive way.
What about the potential that the increase in open banking will force banks who aren't necessarily focused on the smallest of the small, but would it force them to exit some of this market even more? And would that then create a different gap, even though open banking has helped fill some of the gap? Could it potentially another gap come in that kind of leaves some businesses out in the cold because banks no longer would find it advantageous to serve these customers.
But you'd think it would be easier for banks to serve more customers as the open banking increases. So I'm not sure if they would, be moving away from existing customers. I just think that there's going to be more opportunity for fintechs to serve different segments of the market. That's kind of how I would think about that question.
As a reminder to our audience, if you have any final questions, go ahead and begin inputting them now. We have, in just a few minutes left of our conversation here. Thank you, Richard, for inputting that question there. With open banking and the ability to combine the consumer data supporting SMB, where does the CFPB inhibit or benefit SMB? How does the CFPB scope creep into SMB?
I could try to take this one. I think it's a really, I'm not a lawyer, so that's a disclaimer on this. I think this is a gray area from a regulatory perspective. I think most lenders who want to do the responsible thing will try to follow both consumer and commercial lending rules. So they take on that extra scrutiny for themselves. But I think there is a lot of gray area in the regulatory space around SMB lending. So it's a bit problematic, but I think you have to make the right decision for your company as you think about the regulatory landscape.
So we had another one come in here from Peter in our audience. Lots of talk about data, but there's also new tools that are driving change, such as AI, ML, deep learning, that are changing the SME market and access. Do you think we'll get to the point where we'll see some securitization of these loans? And how are non-banks funding these loans? Partnerships, question mark?
A great question. You got to remember the gap in securitization is very, very large. Again, it's like these loans are barely a % of these loans are securitized compared to any other asset class. It is much, much, much more difficult, given the non-standardization of the data, to go out to the secondary markets. I mean, I think Standards and Poor's only rates 20 to 30,000 companies, right? Compared to, all kinds of things that are well known in consumer space. The tools that are coming out, the AI, the ML, a lot of it needs market validation, right? Individual outfits and shops are having a heyday, but I think it's, unless everyone understands, the parameters of what make a great business and business risk in a more common way, I don't think we're going to see any movement in securitization. The credit markets have essentially been frozen, since Q4 last year. Risk is really off. We haven't seen any large commercial loan deals go through the secondary markets. It's I would say that it's going to be quite a while before those got activated. I mean, if you remember in 2008, even the SBA loans stopped trading in the SMB market. That's how badly people understand SMB loans that were guaranteed by the government stopped trading. And it wasn't until the government stepped in, reminded folks their responsibilities under TARP, I think it was TARP, that they needed to make sure that money was flowing in the SMB segment through SBA loans. So yeah, it's a conundrum. I don't quite understand why, but I really do think has to do with data standards and understanding of risk, commonly speaking.
That's also the opportunity there, right? It's like there's a lot of opportunity in the SMB space, given the everything that Isham just outlined. And then just to answer the question directly from Ampla's standpoint, how are non-banks funding these loans? We raised a warehouse facility that we announced, about a year and a half ago. So we have partnerships on that side.
Given that we're in our last few minutes here, I wanted to talk about kind of what comes next and what does the future of this market look like. So maybe we'll go around the room just with some final comments after, I would say focus more on after 23. We obviously know 23 is going to be a challenging year, but kind of what does the future hold? And we've made a lot of progress the last decade or so. And if we're having this conversation in 10 years again, where are we at? Maybe we'll start with Yakov, and then I'll go call out from there.
That sounds good. Yeah, so I think, like you said, Todd, SMB lending has really evolved over the last couple of decades, and we're really continuing to see a lot of innovation. Like we've discussed, there's a lot of fragmented data sets, a lot of fragmented places that we all look to kind of source our information. And so we'll continue to see consolidation and kind of also refinement of that data over the next coming years. I think businesses are really going to benefit as lenders get more tight and more control over those data sets, and we'll see some really strong products and strategies that'll emerge from the current incumbents as well as new entrants into the space as well.
Lindsay, I'll go to you next.
Yeah, I think we're going to continue to see more adoption. And then this is going to become, the goal is it's going to become more profitable, right? It's going to be easier to do. It's going to be faster and be a more profitable business segment than it currently is.
Jim?
Yeah, I would just say that we're still in the very early innings of all of this. A lot of this access to data has really started to take off in the last couple of years. And as, banks and fintechs start to leverage this data, they'll have a lot more history on their loan books and lending to be able to continue to grow this and innovate over time. So I would say that there's a lot of exciting things that are going to happen over the next decade within the SMB lending space.
And Isham, leave us with some final parting thoughts.
Absolutely. Again, I think I said this, I'm going to be redundant, but I think it's an important point. I think people have really waken up to how strong this sector of the economy is from a resilience point of view. And the SMB lending is what, a $2-3 trillion pie, so to speak. And there are a lot of people who are going to vie for that. And I think it's going to benefit these business owners like they've never seen before. The canonical story in SMB lending is no one ever gets money from the banks, right? That's certainly not the case. We had a first wave of amazing fintechs. I'm talking about On Deck. I'm talking about Cabbage, perfected user experience. We learned that, hey, if we treat people nicely when they apply for loans, we'll grow. And then we had another wave of people, like Square Capital, very tightly very close to the workflow and taught us what it's like to be very close to the workflow. And a whole generation of companies, like the Ampla and what Stripe is doing, what other folks are doing in fintech world today that are evolving upon that. So I think there's been a clear evolution, a lot of failure along the way. Trust that, but folks are really understanding how big this could get and how meaningful it could be and how no one has really won yet when it comes to SMB lending.
Well, I think that's a good place to leave it. Isham, thank you. Special thanks to you and the team for your continued support and partnership. Thank you to all of our speakers, to Yakov, to Lindsay, to Jim. Also, special thanks to the audience. I think you had somewhere in the range of almost 20 questions. Yeah, we had 23 total questions. So thank you for your participation. We'll be having sessions like this in the coming weeks and months. So check out fintechnexus.com for more details. And don't forget to buy your ticket today to FinTech Nexus USA coming up May 10th and 11th at the Javits Center in New York. Special thanks again to our speakers. Enjoy the rest of your day, everyone. Thank you.